We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Inflation up year over year, but flat over the short term. But that doesn't seem to be helping consumer sentiment. I'm your host, Eric Lopkin, and welcome to the Raw Naked Truth. And I'm here with Chris Calandra of Elliott Wealth Management for our Wallet Watch segment. And we're going to be looking at what's going on with your money. Chris, welcome.
Thanks for having me today, Eric.
Always good to have you. And of course, we just got inflation numbers, 3.2% year over year, but flat month over month. Does this mean the Fed's interest hikes have been working?
It is an indication that the Fed interest rate hikes are working. Inflation has come down a lot since the peak of June 2022, when inflation was running at a 9% clip. It's still stubbornly high. The Federal Reserve would like to get it more in that 2.5 range. They are within striking distance, and they seem to have themselves in a position, Eric, to pull off what is called a soft landing, where they are able to tame inflation, avoid a recession, and not do undue harm to the economy. Kind of soft landing picture. You're trying to land a large plane, and there's not a lot of margin for error, and you want to land the plane softly. It seems like the Fed is in a position to pull that off, which is a very good outcome if, in fact, that's what turns out to happen.
If they can do it. There are quite a number of folks that disagree that we're going to avoid a recession. Barron's had an article just last week essentially saying a recession is inevitable in 2024.
Yes, I think if you're betting, I just got back from Las Vegas, so I'll use that term. We're likely to have a recession. But I think, Eric, that it's not too scary because it's been anticipated. I mean, this has been a weird environment where a recession has been imminent for something like 20 months in a row. So I think if we get a recession in 24, which I do think is the most likely outcome, it's likely, number one, be pretty shallow. Number two, probably pretty short. And number three will be viewed, I think, as the tail end of an inflation problem, as opposed to an indication that we're in difficulty. If it's viewed, Eric, as the end result and the tail of what transpired over the recent stretch with inflation and the Federal Reserve raising interest rates as aggressively as they ever had, I don't think a recession will necessarily be very problematic for the markets. Does that make sense?
It does. And, we've had a shallow recession just last year where we had 2 quarters, our GDP dropped.
Yes.
We had the brief recession. It didn't seem to slow down the economy much. And I think most people were more concerned about the price of groceries at that point than the recession itself.
Yeah, that's well said.
Now, I do want to push back a little bit on something you just said, because you had mentioned inflation going down. And inflation hasn't actually gone down, just the rate that it's going up has slowed.
Correct, yes.
And I think that's an important distinction. I looked up the numbers this morning, and since President Biden took office, inflation is actually up 18.9%. And the University of Michigan came out with their consumer sentiment survey last week, and then a large number of Americans are not happy with the economy, and they think these high prices are here to stay. They don't expect these prices to go down anytime soon. And in fact, they think that this 3.2% inflation rate is going to stick around for 5 to 10 years. So how is
Yeah.
that going to affect people?
Well, it's going to be very impactful. Thank you for pushing back because my language was imprecise. The rate of inflation growth has come down
Yep.
a lot since last year, and a few things to unpack. If you think about the math, everyone listening to this is if a price went up, let's say 10%, during the height, let's just use a round number. All right. So then it went up 10%. So then you had to absorb that 10% increase. Now, if it only goes up 3%, it's going up 3% from the inflated price, including the 10%. So in terms of dollars, it can be pretty shocking because you're stacking higher percentage than we've seen in a generation. And that's coming off the very rampant inflation we experienced last year, where it went up in a shockingly fast, high rate. So that's the first point. The second thing is consumer sentiment is negative. And I think the report you cited talked about how it has gone down 4 months in a row. I think there's a few things, though. It seems to me that part of this is that people are coming to the appreciation that prices are not going to go back. You touched on that. That this is the new normal. And we're going to reminisce about, hey, when we used to be able to go out and get X for $10, we used to be able to go out and eat and get Y pricing. The people have accepted, given what has happened, we're not going back. And they're probably right. And that can be pretty depressing because a lot of things that Americans are buying are much higher in their budgets than they used to be. And that's causing a reaction, especially for people that are paycheck to paycheck, that are at the lower rungs of economic, in the economic ladder. It's really difficult to absorb these price increases. Another thing I think, Eric, that I want to bring to your attention, and maybe you've thought of this because I know you're extraordinarily well read, is we did a study here at Elliott Wealth Management for clients. And if you go back over the last 2 years, and this runs from October of 21 through October of 23, it has been a really rough go for the markets, not just the stock market, but even the bond market. The bond market traditionally is viewed as a more conservative, safer place to allocate money. But almost any major market index over the 2 years is posting a negative number. When you look at high yield bonds, down 3, US credit, that's basically bonds, down 8.7%. The Dow Jones Industrial Average down 4, International Stock Index down 6, NASDAQ down 9, Russell Midcap down 3.5, S&P down 3, S&P Midcap down 6. And I bring this to your attention. I know we tend not to talk about stocks in the market in any detail, but I think this is playing into consumer sentiment because people don't feel very wealthy, in part because their 401ks, their investments have really not done particularly well over the last 2 years. Now, they haven't nosedived, but they really have not prospered. And when you couple that with what we talked about already, with feeling the pinch of inflation, recognize that this is the new normal, and prices are likely to continue at a faster clip than they have over the previous generation, it's not surprising consumer sentiment is weakening. And the last point I'll make, Eric, before you tell me what you think, is that confidence in the president's administration is not good. When you look at his poll numbers, they are historically weak. And so I think that means that when consumers are thinking about all this and they look for the leadership in Washington, they're not inspired to think that much, if at all, is going to get solved or change. So that's kind of my thesis. What do you think?
Yeah, I think you're right. There's a couple of other factors I think that also have affected consumer sentiment. I mean, certainly the fact that 401ks have not gone up, bothers people because they don't feel like they're ready for retirement. But also credit card debt has skyrocketed, primarily because a lot of people are relying on their credit cards to cover the difference in inflation in just their day-to-day necessities. So that's a big factor. And you mentioned the president's poll numbers. I think it's even bigger than that. We talked a lot about how government spending was affecting inflation over the past year or so. Now we're seeing a change in that because when the debt ceiling fight came up, there was a cut involved with it, and spending was pared back. Where there's a possibility of a government shutdown, which I think they've managed to avoid, but a lot of that is pulling back spending. Even the bill that just passed, the aid for Israel, they insisted that it actually be paid for rather than just spending the money. But the difficulty in the politics of all of this caused Moody's to downgrade American debt.
Yes. Yeah,
So-
I think you bring up a great point. The fiscal behavior of the federal government, led by President Biden and his administration, is very worrisome. And I think I think that's seeping into American psyche and playing into this. I think you bring up a fabulous point.
So one last question before we wrap this up. This is actually something that our friend Jeff Sherman brought up on our sister podcast, Carnivore Radio. I want to get your opinion on this, but he said a lot of what's going on in the economy is a self-fulfilling prophecy. When people feel that things aren't going well, they tend to not go well.
Yes, it is a great point. Not surprising, coming from our good friend Jeff, who I haven't spoken to in quite a while. This is troubling for the economy, this sentiment, because when people don't feel wealthy and they don't feel confident, that affects a lot of their behavior, their spending behavior, their investing behavior. Small business owner who's pessimistic is not likely to hire that next employee, not likely to try and expand their business, open a second location. It has dramatic effects up and down the line in the economy. And that probably also is an indication that recession might finally arrive after a lot of anticipation. I also think in the political realm, that's problematic for the incumbent party. It probably explains some of President Biden's poor numbers. But yes, when people think something bad's going to happen and they react and behave certain ways with their money, they're likely to bring about more negative outcomes than would happen if they were positive. So yes, Jeff makes a fabulous point. It is a self-fulfilling prophecy. And I would expect that consumer sentiment, given this inflation story we talked about already and other factors, probably won't turn around anytime soon, would be my guess.
And that's the raw naked truth. Thanks for being here, Chris. And of course, you can catch the raw naked truth as well as Chris's Simply Financial podcast at xvadio.com/podcasts, the Apple Podcasts app, Google Podcasts, Spotify, iHeartRadio, Audible, Amazon Music, and other platforms that respect freedom of speech. We'll see you next time.